What do we know will happen? So if we're balanced, what do we know will happen when, let's use our VWAP for example. Okay, in relative to where we're trading right now. What will always happen when we're balanced, right? What will stocks do? What will the market do? When the market's balanced, when a stock is balanced, it will always do what? Because you want to understand first, obviously, what environment you're trading in. Okay? If it's balanced, right, we want to then understand we're going to inevitably revert back to our mean, because a balanced market, obviously a balanced market can stay balanced, but by default a balanced market is also ready to go vertical. But during the time the market is balanced, we will revert to our mean and trade around that mean. And so that's where 85% of our trading is going to be spent in a balanced market right now. Okay? And so right now we're trading below our middle VWAP. We're trading down toward our bottom VWAP. And so we use the tide goes in, the tide goes out. You know, it's this predictable thing that you know is going to happen. It's like when a stoplight goes from red to green or green to red, right? You know that it's going to have to turn yellow, right? So it's this predictable rhythm or ebb and flow that, unless you're in Europe, it's this predictable ebb and flow that we can understand is going to happen, is going to play out. So if we are at low tide now, which is going to be our bottom VWAP or our golden VWAP, then we're expecting a move from that bottom VWAP back up to that middle VWAP. Now, it doesn't mean we're going to move through the middle VWAP and hit the top VWAP, but it means we're going to go back to the middle VWAP. So we'll spend the entirety of the day trading around, as long as we're balanced, around our middle VWAP. And price will always come back there, okay, whether it's below. Now, if it's below, it'll typically move back up, pull back down, move back up, pull back down, so it'll keep pulling down to the lower, but moving back to the middle. Now, if you're on the top, typically pull back down, hit our middle, move up, bounce off the top, pull back down, it's off the top, and you'll see the same type of thing happen. So we'll spend the session trading above or below. That's a clean session, but we always come back to the middle VWAP. So the mean point on our envelopes is the 8-day EMA here. You can see the blue line, and you can see how, look at SPY has been trading around our 8-day EMA throughout the entire pre-market, throughout the entire aftermarket. Isn't that pretty cool? All of yesterday, look at, we never even got to reds, traded on our 8-day EMA, pre-market prior, right? Isn't that pretty cool? Gap up off the open for pre-market doesn't count because that's just price adjusting itself, but throughout all of these sessions, okay, because we haven't gone vertical in quite some time, right, since Thursday. All of our recent sessions, we've traded around our mean. We've traded horizontally. So, again, when we see our MAs come together, it's just a quick lesson, but you guys all need to understand this. This is how we trade, right? The algorithm will help. It'll set these levels for you, but if you don't have the algorithm, if you don't have the software, you can learn how to at least trade mean reversion on your own manually without the algo. So, we've got our MAs here. When they come together, when they touch, by default we're ready to go vertical, okay? And when they cross, same thing goes. So we're pretty far apart, right? The market is nice and balanced, and we're gonna spend 85% of our time trading in this environment. So 85% of the time you can either trade around a mean, you can trade off reds back to mean. Now with SPY, the ranges are going to be a little bit different. But let's say Apple. Okay. So Apple, we are, let's see. So without, now look at this. This is like looking at Apple, but we don't have our MAs pulled up. So we're kind of trading blind. We don't understand if we're balanced or not balanced. So if we're vertical or horizontal. So we got to go like this. All right, we're balanced. So we're balanced, but we've moved, you know, a decent amount outside to the upside of our mean, okay? We're trading on greens. Trading on our top VWAP here. And realize how, because we're balanced, we've moved from top VWAP to middle VWAP to bottom VWAP to middle VWAP to top VWAP to middle VWAP. That's not by coincidence. It's not by chance. It's because we're in a balanced market. And so, yes, you could take shorts off the high to the low, get into longs, take longs off the low to the high, get into shorts, take shorts off the high to the low, and trade around that mean, right, as our control point, or a POC, our point of control. And I can look at our envelope system here, same thing. We've got a high at 269.87. That was slightly above our green band. Our second bar formed a lower price, and it was in relative to previous high price. Well, on the same band, but slightly lower. Okay. Now we're down here below reds. So that would let us know, hey, this is the top. We failed to break. We didn't form on a higher band. We can look at volume. We can look at MACD to understand how fast we are moving. Okay. So you can see our MACD is right around, my mic is always blocking my screen, 0.84, 0.85. So pretty wide open here. We're still pointing up. Okay, we're still pointing up. So momentum is still pointing up, which is interesting. Okay. So we'll see now if we stick below and move back down to our low tide, or if we hold here. But the point is, this is where you become like one with the market, right? If you're short at highs, that's an easy TP, because we know we're going to move back to our mean. What is a little bit more difficult is to then squeeze another move below middle down to low. This is an instance of, let's look at all of our indicators and see if we've got it, right? Buyers got shut off here, and you could look at it as that. I mean, this was a real big wick. That high just touched our top view up there, 269.87. So there are definitely some buyers trapped up here. But buying was shut off pretty hard and pretty fast. Now, on the other hand, I would have been, again, more predictable. Obviously, we know we could have taken shorts and gotten out here for profit. Then it's a question of how much more do we have. Now, when we move back to here, this is another instance. If you're looking at longs, we don't really know if we're going to get exactly back up to top VWAP. But if we were back up there, we could take a second stab at shorts. So these would have been two shorts. This would have been a little tough, right? That was a quick one. But shorts to mean, those would be two easy shorts on VWAP, predictable, right? Because the market has to move back to our mean. We look at speeds because we want to understand that our mean as our VWAP, volume weighted average price, and as our envelope system, they're all MAs, moving averages. So they're, in essence, they're going to trail, they're going to move. And the faster the stock's moving, the faster those moving averages are going to move. And that's what MACD measures, moving average convergence, divergence. So if we have targets at our mean and we're expecting a retracement to our mean, but we're moving so fast that our mean is therefore effectively trailing up, well, a mean can trail up to your entry where you're short at highs, and then because MACD's pointing up and we've got enough buyers getting involved, and the speeds are increasing, right? The mean can quite literally trail up to your entry. So be aware of that, right? As we're pointing up here on all of our bands, we're pointing up, okay, we're pointing up. If you look and you see all the bands start pointing up, okay, now let's look and see, hey, well, MACD, sometimes you have to kind of zoom it out. Sometimes I'll place it on the chart. We want to look at these bars. I call them bars. So there, right there, we just flashed slightly above the previous bar. If we see higher bars on the MACD being formed, okay, so higher, this was a higher bar, right? This bar right here, okay, was a higher bar than this bar right here. Now we're seeing if this is going to be a higher bar than the previous bar. So that is measuring these two, okay, moving averages. This is just measuring all the moving averages as they move. And as the market speeds up, they'll get further and further and further and further apart. But then they have to at some point come back together. So they'll get far apart, but they will have to come back together by default. And when they come together, if they cross, some people use that as a sell signal or a buy signal, whether we cross above or cross below, right, on an uptrend or a downtrend. I like using it to measure and understand how fast is my mean going to move, or my POC going to move off of, well, wherever I am. Because if I'm in shorts, okay, if I'm in shorts here, and all of a sudden the market's moving really fast and my middle VWAP moves up here, you can see how my margin for profit on my shorts would kind of get crushed, right? And so understanding speeds and how fast we're moving and how aggressive at the same time those buyers or sellers are. You can see how many people are getting involved in the move. Volume's like semi-helpful. Honestly, it's not something I look at too much. It's really not. But I like measuring the speed at which our MAs are moving, which is going to help us understand, again, when are we kind of wrong? Because even though we know we're going to move back to our mean, it is then a timing factor. And all of these time frames, these are meant for intraday, day trading, right? So realize the market's going to balance out on maybe a 1 minute first, a 5 minute, a 10 minute, and then eventually it'll balance out on a 4 hour and a daily. It doesn't all happen at the same time on every time frame. So because we're balancing out on a 30 minute, okay, we're balancing out on a 30 minute, well, true. So, and you know, there are two ways to look at this. I will say, technically, we like keeping it easy, right? If you guys are following along, you're watching the YouTube videos, you're going to be watching the series of videos that I filmed back in the summer of 2022, where I sat down with these two Wall Street veteran traders, Chris Cady and Steve Hawkins, right? You got to tune into the YouTube channel to watch those videos. That's where I learned all of this, right? Went to Wall Street, traded with them, and this is like the fundamental. This is trading extracted off the floor, right? When the floor went virtual, right? There's no one trading. Well, there is a small floor now, but there's you can't buy a seat. You can't go trade on the floor anymore. It's a different environment. There's just institutions and funds in there, not individuals. So Chris had a seat on the floor. He traded in the pit as a floor trader, and so he extracted a lot of that knowledge out of the market and brought it into like very usable terms. So if we're looking at balance, imbalance, horizontal, vertical, and we're looking at mean reversion, and we're using these MAs to measure balance on a 30-minute time frame. Technically, when we're apart, this is the market trying to find balance, and then when they come together, the market is balanced, and when it's balanced, at that point in time, it's ready to go vertical. But it's more easy to look at it as, okay, as long as they're far apart, we're balanced and or finding balance, and as soon as they come together, technically now we're in true balance and ready to go vertical. That's why you see whenever we come together. This is technically a true point of balance. By default, now the market's ready to go vertical. And we could see that, okay? Right? Every time they come together across, okay? And sometimes it'll be like slightly trailed after, slightly trailed before. It kind of just depends on the stock. And again, it's like a quick and dirty way of finding balance. It's not going to work 100% of the time, as nothing will. Just looking at some different stocks here. So like look at that. That's a pretty good example. Okay, market is balanced, or again, you can look at it as trying to find balance, and now the market balances out here. By default, we're ready to go vertical. So our lines came together, they got flat, they crossed, and then look at that ginormous vertical move. Okay, look at that. Cross, and then just huge dump, right? Cross, right before the open, boom, big rally. So balanced or finding balance, found balance, by default ready to go vertical, huge vertical move. Like Citi looks like one that would be pretty easy to trade. So Tesla's probably a little crazy. Every time you could see, like before these giant moves, okay, this is before, like you'll watch the MAs come together in real time. Boom. Before that giant vertical move on Tesla, we got balanced, and by default, we're ready to go vertical. Right? So I always say, okay, we're balanced. Now when the MAs come together, we're ready for a vertical move. Which is, it's the same thing. It's just terminology, right? It's just the way you want to explain it. We're balanced, ready for a vertical move. Okay. Pretty cool, right? So that's market auction theory is a whole different thing we'll learn about later on, but that's really, really solid. If you come into the market not understanding what environment you're in, this is not made up, right? If you understand balance and balance, horizontal, vertical, understand that 85% of the time we're going to be in balance, trading balanced, okay? And the other 15% we're going to be trading not balanced or in vertical. When we're in vertical, we're not going to come back to our mean. We're going to keep moving off of the mean further and further and further and further, okay? So you can use this. You can really use it because it really works, and it just depends how much you want to be involved, because I would look at trading around our point of control or our point of balance, our middle VWAP, or our 8-day EMA, that you're kind of like, it's not scalping, but on the time frames we're on, you're going to have a lot of opportunities frequently. It's kind of like paying the rent, right? Like you can pay the rent trading mean reversion. Now if you're, let's say, trading in a market that is not balanced, trying to capitalize on a vertical move, that's when, that's what I say, you go out and you catch that big fish, you catch that big tuna, you're going to be able to capitalize on these huge vertical moves. You're not going to come back with something every day, but when you do, you're going to come back with something huge. And so how consistent do you want to be, and how much time do you want to spend doing this? And then get involved during that time